There is a man who has put more money into Bitcoin than any other human being alive. Not a hedge fund, not a country, one man. And this week, he made a statement that the mainstream financial press largely ignored, but that every serious Bitcoin investor needs to hear. Michael Saylor just said the bottom is in. Not as a hope, not as a tweet designed to pump the price, as a conclusion drawn from a framework of analysis that has guided the single largest corporate Bitcoin accumulation strategy in history. And whether you trust him, doubt him, or have never heard of him, what he knows about Bitcoin's supply mechanics, institutional demand curves, and on-chain behavior puts him in a category very few people on this planet occupy. By the end of this video, you are going to understand exactly what Saylor sees that most investors don't, what the data actually says about where we are in this cycle, and what the next 6 to 12 months are likely to look like based on the historical patterns that have played out every single time this market has moved through a major accumulation phase. If you are someone who wants to understand what is actually happening in the Bitcoin market, not the headlines, not the price tickers, not the fear-driven commentary, but the structural data and the institutional logic underneath it all, this channel is where that analysis lives. Every video goes deeper than the surface. Hit subscribe and turn the bell on so you never miss a breakdown like this one. And if this video gives you something the rest of the internet isn't giving you, the like button tells the algorithm that more people need to see it. Now let's get into what Saylor actually knows. Michael Saylor is the executive chairman of MicroStrategy, a company that has accumulated over 200,000 Bitcoin on its balance sheet. That is not a typo. The company began buying Bitcoin in 2020 as a treasury reserve strategy, and has continued to buy through every drawdown, every panic cycle, every regulatory scare, and every moment when the consensus on financial Twitter was that Bitcoin was finished. He made his statement in a recent public appearance, laying out his case for why the current price level represents not a warning sign, but a structural floor, a zone of accumulation driven by forces that are fundamentally different from the retail-driven rallies of previous cycles. On the surface, this sounds like what it always sounds like when a major Bitcoin holder talks bullishly. But here is where the data starts to tell a very different story. And before we get there, we need to understand what actually happened to Bitcoin's supply structure in the last 18 months, because without that context, nothing Saylor is saying makes sense. So why does this actually matter? Because if Saylor is right, and the structural evidence supports the idea that a genuine floor has been established, then we are sitting at the beginning of one of the most asymmetric risk-reward setups in Bitcoin's history. And most investors are completely missing it. Here is why. The traditional model for thinking about Bitcoin bottoms has always been retail-driven. Retail panic creates selling pressure. Selling pressure drives price down. Price falls far enough that early accumulation begins. Word gets out. Price rises. Retail chases. Price explodes. That is the old model. What Saylor understands, and what the current market structure reflects, is that the demand side of this equation has been permanently transformed. The Bitcoin ETFs that launched in the United States absorbed billions of dollars of institutional demand within weeks of their approval. That demand did not go away when price pulled back. It continued, quietly, methodically, with the kind of patience that only exists when the buyers are pension funds, registered investment advisors, and sovereign wealth managers who are building multi-year positions. For retail investors, this means the floor under Bitcoin's price is structurally different than it has ever been. For institutions, it creates a positioning dynamic where early movers have an enormous advantage over those who wait. And for the broader financial system, this is a signal that the era of Bitcoin as a fringe speculative asset is ending, and the era of Bitcoin as a legitimate reserve asset is just beginning. Stay with me, because this next part changes the way you think about the entire situation. The crowd right now is doing what the crowd always does. It is oscillating between optimism when price rises and anxiety when it pulls back. The fear and greed index swings. Social media sentiment tracks price like a shadow. Retail investors watch the weekly candle and decide whether Bitcoin is in a bull market or a bear market based on what happened in the last 7 days. That is not how serious money thinks. And this is the divergence that matters most right now. On-chain data from the last several months shows a consistent pattern of large wallet accumulation during price weakness. Addresses holding more than 1,000 Bitcoin, the wallets that analysts track as proxies for institutional and high net worth behavior, have been increasing their holdings. Meanwhile, exchange reserves have been declining, which means coins are leaving the liquid market and entering cold storage. Coins that go into cold storage are typically coins that are not for sale at current prices. The crowd is looking at the price chart. Smart money is looking at the supply leaving exchanges and drawing a very different conclusion. This is not what it looks like on the surface. What looks like market indecision or consolidation is, structurally, one of the most aggressive periods of long-term holder accumulation in Bitcoin's history. Now here is where the historical comparison becomes extremely important. In late 2020, before Bitcoin's move from roughly $10,000 to $65,000, there was a period of approximately 90 days where price did very little. It chopped sideways. Retail interest faded. The sentiment data showed boredom. And underneath all of that, on-chain data showed exactly the same pattern we are seeing today. Declining exchange reserves, increasing long-term holder supply, whale wallet growth, and a flattening of the short-term holder cost basis. What happened next surprised almost everyone, except the people who were watching the right signals. Now go back further. After Bitcoin's catastrophic decline in 2018, which took the price from nearly $20,000 all the way down to $3,000, there was a prolonged accumulation period that looked, to the untrained eye, like a dead market. Volume was low, sentiment was apocalyptic. Mainstream media had declared Bitcoin dead for the 14th time. But the on-chain data told a story of quiet, relentless accumulation by wallets that had survived the worst of the bear market and were loading up at prices that would never be seen again. The structural parallel to today is not perfect, no historical comparison ever is, but the pattern of institutional accumulation during retail despair has shown up at every major Bitcoin bottom in the asset's history. Saylor is not making a prediction, he is reading a pattern. Now let's get into the data itself, because this is where Saylor's confidence is actually anchored. The MVRV ratio, which measures the relationship between Bitcoin's current market value and the aggregate value at which all existing coins were last moved, is currently sitting in a zone that has historically preceded significant upward price movement. When the MVRV is low, it means that the average Bitcoin holder is close to break-even or slightly underwater. There is no euphoria in the market. There are no late buyers sitting on enormous unrealized gains waiting to sell. This is a structural characteristic of market floors, not market tops. Exchange reserves are at multi-year lows. This is perhaps the single most important data point in the current setup. When Bitcoin leaves exchanges, it is leaving the pool of liquid supply that can be sold at any given moment. The coins going into hardware wallets and institutional custody solutions are not coins that will hit the market the next time price moves 2% in either direction. They are long-term commitments. The market is being drained of available sell-side supply. Corporate treasury accumulation continues to accelerate. Beyond MicroStrategy, the number of publicly traded companies that have added Bitcoin to their balance sheets has grown significantly. This represents a fundamentally different ownership base than the retail-heavy markets of previous cycles. Owners who bought Bitcoin as a strategic reserve asset, not as a trade, and who have disclosed holding periods that span years, not weeks. The real story is happening underneath the surface, and the macro context is what makes it all click into place. We are in a global environment where the relationship between governments and their currencies is under extraordinary stress. The United States is carrying a national debt that has crossed $35 trillion. The Federal Reserve has spent the last several years navigating between inflation control and growth support, and the market is now pricing in the beginning of a rate-cutting cycle. When rates fall, liquidity expands. When liquidity expands, capital flows into assets that can absorb it. And Bitcoin, with its fixed supply of 21 million coins and its complete independence from any government's fiscal decisions, sits in a unique position. The dollar's long-term purchasing power trajectory is not a matter of political opinion. It is arithmetic. Every dollar printed dilutes every other dollar in existence. Bitcoin's supply does not respond to political pressure, economic necessity, or central bank policy. That asymmetry between infinitely expandable fiat and algorithmically capped Bitcoin is exactly the asymmetry that Saylor has been articulating since 2020, and it is the asymmetry that is now being validated by the behavior of the world's most sophisticated capital allocators. Now let's build out both sides of this picture, because intellectual honesty demands it. The bull case is this: the post-halving supply reduction has removed the equivalent of approximately 900 new Bitcoin from daily market supply. That reduction happened precisely at the moment when ETF-driven institutional demand was accelerating. Basic supply and demand mechanics suggest that when you reduce supply and increase demand simultaneously, price rises. The historical precedent from both the 2016 and 2020 halvings shows that the strongest price appreciation typically comes in the 6 to 18 months following the halving event. Combined with a Federal Reserve rate-cutting cycle that expands liquidity, a dollar that is under long-term structural pressure, and an institutional ownership base that is buying on weakness rather than selling into it, the conditions for a significant Bitcoin appreciation phase are not just present, they are converging in a way that has no historical precedent in terms of scale. The bear case is equally serious and deserves full respect. Macro conditions can deteriorate faster than anyone expects. A resurgence of inflation that forces the Federal Reserve to delay or reverse rate cuts would tighten liquidity across all risk assets, including Bitcoin. A major geopolitical shock could trigger a forced deleveraging event where institutional holders reduce risk exposure indiscriminately. Regulatory risk has not disappeared. Governments facing fiscal pressure have both the motive and the theoretical ability to restrict Bitcoin activity in ways that could disrupt adoption curves. And historically, even after the strongest accumulation phases, Bitcoin has shown the capacity for violent corrections of 30 to 50% before continuing its long-term trend. The bottom being in does not mean the path is straight. I will tell you exactly what I think happens next, but you need to watch for three things to know which scenario is actually unfolding. The first is the Federal Reserve's upcoming communications on the rate cycle. Any language that signals an acceleration in rate cuts is a direct tailwind for Bitcoin's liquidity thesis. Language that suggests delays is a headwind. The second is the continued trend of exchange reserve data. If outflows persist over the next 60 to 90 days, the supply compression thesis remains intact and becomes progressively more powerful. If exchanges begin seeing inflows, meaning coins are returning to the liquid market, that is the first warning signal that long-term holders are beginning to distribute. The third is corporate treasury activity. Watch the quarterly disclosures from major Bitcoin holding companies and watch for any new entrants among Fortune 500 firms. Each new corporate adopter changes the structural demand floor. Saylor is not a prophet. He is a man who has structured his entire corporate strategy around a set of beliefs about money, scarcity, and institutional behavior that have so far been directionally correct. He has been wrong on timing before. MicroStrategy's average cost basis is well above the prices seen during the 2022 bear market, and the company faced enormous paper losses that would have destroyed a less committed balance sheet. But his core thesis about Bitcoin's long-term trajectory has not been disproven, and the framework he is using to identify this floor is the same framework that has identified every major bottom in this market's history. What we are watching in real time is the institutionalization of a market that spent its first decade being dismissed as a toy for criminals and libertarians. The same banks that called Bitcoin worthless are now custodying Bitcoin for their clients. The same regulatory bodies that once threatened to ban it are now approving instruments that allow pension funds to own it. The same macro environment that once made Bitcoin seem like a speculative curiosity is now making it seem like the most rational response to the financial system's structural contradictions. Saylor says the bottom is in. The on-chain data largely agrees with him. The macro setup provides a credible narrative for why this time is different in the ways that actually matter. The question I want you to think about carefully before you answer in the comments is this. If the institutional adoption of Bitcoin as a reserve asset continues at its current pace for the next 5 years, does that permanently change the shape of Bitcoin's market cycles, creating higher floors and more compressed drawdowns? Or will the sheer scale of new capital eventually create the same irrational euphoria that has ended every cycle before this one? There is no clean answer to that question, but the way you answer it will shape every investment decision you make in the years ahead. Let me know what you think below.